But first, Turkey's currency, the Lira, strengthened this week after a major sell-off, which saw it hit an all-time low versus the dollar. It's still down around 15% so far this year. And for ordinary Turks and President Recep Tayyip Erdogan, it's a big source of worry. He's been battling to stop the currency crisis ahead of elections next month. In the past week, there's been a steep interest rate hike. The central bank governor has also tried to reassure foreign investors that capital controls, which would block money leaving the country, won't be needed. Although in the short term this strategy seems to have worked, challenges remain. On Wednesday, credit ratings agency Moody's cut Turkey's economic growth forecasts. Well, joining us now from London is Charles Robertson, Global Chief Economist with Renaissance Capital. Thanks very much for being with us. So what's going on with Turkey's economy, particularly these big swings in the currency?
It's taken a while, but there's been a massive build-up of debt, private sector debt in Turkey over the last 10, 15 years. And we've been concerned for the last 2 to 3 years that at some point in the medium term, like now, you're going to see lending stop, growth stop, and then people flee Turkish assets because people have been buying into Turkey on the assumption it would grow 5% forever. And the risk is it's going to slump into recession.
And why is that?
Because it's that borrowing of too much. It's not particularly the size of the borrowing now. Private sector debt's about 70% of GDP. China's double that. It's the scale of the increase over 10 years usually coincides with excess borrowing, bad borrowing decisions, perhaps into real estate or something similar. And that tips over. We saw it a lot in the global financial crisis. A lot of Eastern Europe had that problem. To some extent, the US had that problem with the global financial crisis.
Questions being raised as well, though, about President Recep Tayyip Erdogan's leadership here and his stewardship of the economy. There were the comments that he made earlier describing high interest rates as the mother of all evil. And that kind of took a few people by surprise, didn't it? And it raised questions about how independent the central bankers are in Turkey. The
difficulty here is that Erdogan was the market's darling for a good decade or so. And there was always local concern, particularly among the kind of middle-class Istanbul electorate, that he was encroaching, his power was getting too great. He's now been in power for so long that there is very little constraint upon him. He's appointed numerous central bank governors now. He's in charge of the army. He's done a lot of changes to the judiciary. But it's the central bank which I think has concerned people the most, because Turkey relies on foreign capital to fund its current account deficit. It always runs a big trade deficit. So it needs foreign capital. So to say we don't want to pay the interest rates required to attract that capital has frightened the markets. And one of our concerns over the last few weeks is if you go back to Malaysia in 1998, in the Asian crisis, Malaysia said, you know what? We're not going to take foreign capital. We're going to introduce capital controls. We're going to not allow foreign portfolio investors to leave. And that did let them cut interest rates. And it did help Malaysia's economy recover perhaps quicker than other Asian countries that had gone to the IMF and done orthodox things like the interest rate hike, which eventually Turkey did choose to do a few days ago.
Yeah, and staying on this, the issue of the interest rates, the Lira did rally further this week after the central bank announced this streamlining of interest rate tools to focus on having one single main rate. Has that done anything to reassure investors?
It's done. It has helped. It has helped. So the 300 basis point rate hike has helped. Having interest rates up at around 16% has helped. But also, for a number of years now, the central bank has been trying to raise rates, but not tell the electorate in Turkey that they're raising rates to try and keep the president happy. And this repo rate, which was sitting at around 8% and has now been raised to 16.5 or so, that is a sign that finally orthodoxy seems to have won. And in the longer run, that will work. It worked for Russia when they did similar things a few years ago. Russian interest rates are much lower now than Turkey. Russian inflation much lower now than Turkey. So orthodoxy does win in the end, and it looks like Erdogan has given up. He's backed away. The central bank's being allowed to do what orthodox people would suggest and what the market wanted to see.
What does that mean for Turks, though, when they're getting paid, continue to get paid in lira, and their currency is seemingly losing value on the international markets?
It's tough. It's interesting that a couple of years ago, Erdogan suggested that Turks should save in lira or gold. And gold has actually been a relatively good store of value for Turkish people. Real estate, quite a good way to try and protect your savings. But the lira itself hasn't been great. So you're going to see inflation rise. That's going to hurt people, usually hurts the poorest. We think we're going to see growth slow to, at best, 2 to 3% this year. And the population's growing 1 to 2. So per capita, that's really not much of a gain. These are tough times for Turks now.
Good to speak with you. Charles Robertson joining us there in London. Thanks very much.
Nice to talk to you.